After a budget shock of STT hike in F&Os, SEBI has also issued a consultation paper on a framework for increased investor protection and market stability in the F&O segment. But why? Well, as per a study conducted by SEBI, previously indicated that 90% of the trades in the F&O segment resulted in losses. Yes, 90%. Every day, Indians are losing their massive amounts of hard-earned money in derivatives markets, up to 60,000 crore rupees in a year. By doing what? Gambling on F&O contracts. Now, this is an issue, a serious issue, and SEBI has taken this into account. So now, to manage this situation, SEBI has proposed 7 measures to bring market stability in this segment. Number 1, rationalization of strike price for options. Strike price is a predetermined price at which the call or put options contract can be traded on or before a pre-decided date. As of now, Nifty and Bank Nifty option strikes cover roughly 7 to 8% of the index movement on a given day. Nifty has a total of 70 option strikes, while Bank Nifty has 90. SEBI has proposed that not more than 50 strikes will be introduced at a time of the contract launch. Strike interval must also be uniform near prevailing price and may go up to 8% only if needed. Number 2, upfront collection of options premium. There is currently no stipulation of upfront collection of options premium from the options buyer. SEBI has proposed to collect this premium on an upfront basis. Number 3, removal of calendar spread benefit on expiry day. Calendar spread margin applies on expiry day for 2 F&O positions with different expiries as against 2 normal F&O positions. Now, this helps in reducing the margin requirements significantly. SEBI has proposed that no calendar spread margin for contracts expiring on the same day will be introduced. Number 4, intraday monitoring of position limits. As of now, the limits are monitored at the end of the day by MIIs. Now, SEBI wants position limits of index derivatives to be monitored on an intraday basis with an appropriate short-term fix and a glide path for full implementation. Number 5, minimum contract size. As of now, the minimum contract size requirement is of 5 to 10 lakh rupees. SEBI has proposed that in phase 1, the minimum contract requirement will be around 15 to 20 lakh rupees, and in phase 2, after 6 months, the implementation of contract size will be 20 to 30 lakh rupees. Number 6, rationalization of weekly index products. Weekly expiry of index derivatives has resulted into 1 expiry every single day of the week across indices and exchanges. Now, the proposal from SEBI is to have weekly expiry for 1 benchmark index per exchange. Number 7, increase in margin contract expiry. As of now, no additional margin is required in the last 2 trading days of the expiry. SEBI proposes to collect additional 3% extreme loss margin at the start of the penultimate day of the contract expiry. On the last day, ELM is proposed to be increased to 5%. Jefferies has warned that exchanges and retail-focused brokers will be the most affected by these changes. BSE might see a positive impact if the volume spills over from discontinued products, and today we saw BSE stocks surging. Brokers like Zerodha, Angel One and Paytm Money may face significant impact, especially from the removal of 12 out of 18 weekly option contracts. So now, what is an F&O contract? Say you think that the price of a particular stock will go up. With F&O, instead of buying the stock from the market itself, you sign a contract with the broker. If futures contract is signed, then you buy the particular stock at a predetermined price on a predetermined date. For example, you assume that stock A will go up to 400 rupees in 1 year. So you sign a futures contract with the broker of stock A saying that you will buy the stock after 1 year at 390 rupees. He agrees, and in 1 year when the prices go up, you buy the stock and make a profit of 10 rupees. In options, you do the same thing, but you also have the option to not buy the stock on the particular date, which means that there is no obligation. Now, why is this risky? It is risky because say your prediction goes wrong, stock A falls to 100 rupees in 1 year, then you make a massive loss of 290 rupees on this stock because you signed a contract and you have to buy the stock at this predetermined price. Unlike stocks, F&Os are not very straightforward. F&O pricing is complex and function on multiple variables like volatility of the stock, time till expiry, strike price, discount rate, current stock price, and more. And pricing is also easily swayed away by external elements like speculation, sudden market reaction, causing irrational price fluctuation in derivatives market. If this still sounds complicated to you, imagine how many common people who don't understand this setup are losing money every day. There has been an exponential rise in F&O segment participation from 7.1 lakh in FY19 to 45.24 lakh in FY21, which is a massive 500% increase. What this says about us, well, as humans, we want quick profits, but buying or trying to get 0 to 100 without knowing the right path might bring you from 0 to minus 100. So invest wisely, don't take risks that you cannot bear. Learn the market, analyze the segment before you invest into it, because this is a risky bet and you don't want to end up in a massive debt. For better knowledge of investing and finance, stay tuned to ET Now, and I will see you in the next video.
If you like this video, then like, share and subscribe to ET Now.